First and foremost, thanks Alex for putting these on, and well done for everyone here spending your Friday morning learning about real estate with other real estate nerds. It's great to see. Today we're going to be talking about a few things. We'll give you a little bit of introduction on ourselves, a bit about the podcast, and then we're really here to talk about a few things that are very relevant right now from both a legislation perspective, an opportunity perspective, and something that we're actually involved in hosting and putting on, which is the Missing Middle Summit next Thursday. I'd highly recommend everyone come. If you use, we have a discount code. I think there's a few tickets left.
Yeah, it's not sold out yet, but it's pretty close. I think there's only like 5 or 10 tickets left, so not all of you can count. But I don't know, try missingmiddlesummit.com. Chris Foch, who was here at the first meetup, right?
Yep, in January.
He's putting it on, and yeah, if you use the code TCREI, the Canadian Real Estate Investor, I think it's 20% off at checkout.
Yeah, and if you want any of this stuff afterwards, just DM one of us and we can get you all the information. So, a bit about us. We just talked about the podcast. Dan and I have been podcasting for about 2 years. We started, and we basically just hopped on and started interviewing people. This is obviously a much more, well, it's actually usually a much more tanned version of us in the photo, but yeah, we just started interviewing people a few years ago and had a great time doing that. Made a bunch of friends, got a bunch of deals done, and then we were approached by the Canadian Investor, which is probably the biggest business podcast in Canada. Gets about 150 to 200,000 downloads a month. They were getting a lot of requests for a real estate podcast. They didn't know enough about real estate to feel comfortable talking about it twice a week for an hour each morning. So they approached Dan, and we were already doing that. So we rebranded, and it's kind of changed our lives since. We're now doing deals across the country from literally none of it, Yellowknife, East Coast, West Coast, and everything in between. So,
Yeah.
anything you want to add to that?
No, I don't think so. I think, most of what we're going to be talking about today is we're sort of in the infancy of developing a credit product that's based on the needs of our audience. And so one of the things that we found is more and more people, small cap investors, are feeling compelled to play a role in solving the housing crisis and also make money by adding one single unit to duplexing a property, or now in the city of Toronto, triplexing or fourplexing a property, or adding a detached ADU. And in a lot of cases, I know that the headline of this is buy, demolish, build back better, but in a lot of cases where we're seeing the economics of that really working are in the retrofit space. And construction loans are really, there's good construction loan programs when you're getting into ground up construction, but in the renovation space, there's not really specific credit products designed for this. And one of the reasons we're going down this road is a tech partnership that we have. It's really aligned towards trying to get in through CMHC's Affordable Housing Accelerator program. We're going to talk a lot about this, like in the fullness of time, throughout this presentation, but that's kind of like a context of where we're at. We've seen insane amounts of demand for people who want money to add a unit, and right now that it's kind of happening in the HELOC space. I think for most of you who are in the mortgages, and it's not working well enough to deliver the housing supply that we need to see that should be happening as a result of a lot of these new policy changes. So we want to change that. Okay.
So here we'll see home ownership declining. So basically, if you go back over 10 years, back to 2012, 69% of Canadians owned a home. We have seen that decline to just over 66% now. Obviously, it's no mystery as to why: interest rates, inflation, lack of skilled trades, and essentially just a lack of barrier to entry for a lot of people to get into the housing market right now from both a building perspective as well as a purchasing perspective. We're here to talk about the missing middle, and the missing middle isn't just part of a housing stock or a housing product that's missing, it's also part of a financing piece that's missing to actually fund that kind of stuff. So if we look at the real estate broker side of things, we're right at home, we've got right here, obviously. These are all the most common brands that you see for single family, even for some small multifamily, and then it kind of jumps all the way to the guys that occupy the towers downtown and buy and sell the towers downtown, the JLLs and CBs of the world. You've got some people that play in the middle space like a Leonard or something like that, but not really, and not enough of an expertise there. And that's the same in the mortgage space. You know, we have a lot of mortgage people here. I'm obviously a mortgage agent by trade as well. And I know we've left it blank, and then there's probably some people being like, well, there's some people that fit in that space, and of course there is, but there's no one that has expertise, and there's no one that's built credit products to specifically supply that part of the missing middle. So again, at Landbank, which Dana's gonna jump into right after this, we read this quote and we kind of wanted to adopt our business model around it. So too big for the small groups and too small for the big groups. Mm-hmm. And that right there is the missing middle.
So Nick and I work together at a debt equity and investment sales advisory group called, so we work at Nick's a mortgage broker, I'm a realtor, but we work with missing middle clientele. So we do a lot of land development, so brokering sites, helping to assemble land, selling them land, and then taking it all the way through from financing the land all the way through to construction. So in the fullness of time, waiting for some FSRA approvals right now. They don't like the word bank very much, but we'll be a brokerage and a mortgage administrator. So when we talk about the missing middle space and like how you're kind of in the service spectrum, there's a missing middle as well. So you have the brokerage is not, there's a lot of people not serving that middle clientele. So we get a lot of referrals from your CBREs where they'll send us high street product as an example. So, you know, a $2 million 5-unit mixed use commercial building. I sell a lot of those, and CB doesn't want to sell them, and your typical Remax agent can't sell them. And so that's the missing middle on the service side. Same thing on the finance side. I think in a lot of cases there's not a lot of lenders who are doing stuff. I think probably Firm Capital would be maybe the most active in that middle space of like, you know, laneway houses, rooming houses, garden suites, stuff like that. But there's not a competitive environment, and so we see a lot of referrals from small residential brokers who have clients who, you know, are sophisticated investors that need construction and takeout financing for, you know, a missing middle-esque project, and typical residential broker isn't going to service that exceptionally well. Typical large-scale, more capital markets broker doesn't have the time to, and so that's where that missing middle evolved as well. What we're seeing happen in the same scope is, you know, you have an upper and a middle tier of, and this all just happened because the missing middle exists. Like, because there was never any housing in the middle of the market, you literally have a small market and a large market. And so you have these massive institutions now on the ownership and development side, and then you have basically the small end, which is mom and pops, and then small corporations, small developers that are starting. Like Paul would be a great example of somebody who, and the way I see it is, you know, and we had arrows on the other slide, but the way I see it is that this lower end of the market is really what's going to be pushing into the missing middle space. I don't see these players having an active or meaningful role in the missing middle space. So to me, this is a huge opportunity for us as real estate investors, but there are some things missing from it.
And so just an example for everyone that's maybe not familiar with exactly what the missing middle is. If you look at most North American cities, Toronto's a perfect example of it. We're in what's called the Central Business District right now, and essentially that's, you know, all the major towers built out from there. You've got condominium towers. And then all of a sudden it drops from about, you know, 30, 40, 50 stories all the way to single detached or small multifamily homes. There's nothing in the middle of that. There's no 6-story buildings, there's no 4-story buildings, there's no 12-unit buildings in between that. If you go to any city, Amsterdam, Copenhagen, Paris, cities that were built a long time ago with a better urban planning, better planning overall, they actually built like that, and it's much more of a lifestyle, and it kind of plays into that new 15-minute city that we're probably all hearing about right now.
For sure. I think another component is they also couldn't build skyscrapers back then.
Yes, that's it.
But it turned out to be the right thing, right? So it is really interesting the way that whole thing has happened. So the way that the capital markets are structured today, and this is basically the size of this is your trade volume and total addressable market, and then kind of the height of it is the sophistication level of the structure. So you have high rise, which is high rise construction financing is basically, there's really only like your 6 big banks are the ones that are playing it. Some of your Desjardins, like your big life cos and pension funds are playing in that space as well. But in $100+ million construction financing deal, no one lender can even take that on. Like they're literally legally not allowed to. It's too much exposure. So you'll see that syndicated out with like 4 lenders. So you'd have, four of the 6 big banks would all be lending on a project like this. And sometimes you'll get bonding from Wall Street, like you'll get a Blackstone maybe taking something out, but that's how that works. So we're not playing in that space. Those extremely sophisticated clients, they don't need services typically from brokers like any of us in the room, right? It's very hard for us to provide value for them. Mid-rise, you start to see a little bit more because there are clients who bought land really well, developed really well, and created enough value, and they start to push in kind of out of that syndicated space. The projects are a little bit smaller, can be done by one single lender. There's opportunity. Low-rise space, we all know, for all of us, I mean, there's a lot of people in the mortgage space in this room, so we all know that, you can go to a big 6 bank or there's a lot of B-side activity, a lot of credit union activity in the low-rise space. Majority of the transactions, that's why it's the biggest piece of the pie, but smaller deals. Missing middle, I think, from a professional perspective, a lot of opportunity to get bigger deals, and there's, as of a couple of days ago in Toronto, there's a massive amount of them, right? You can fourplex anything in the city of Toronto, if we could find the money to do it. And this is where you end up with what we would call the missing money, or the missing middle of the capital market. So scale-wise, mid-rise would be the top end of your missing middle. So over 4 stories is typically not in missing middle. And then this line here is basically where CMHC comes into play. So over 5 units, you can get what's called MLI Select. And that's CMHC construction financing that allows you to build a 5-unit with exceptionally cheap money and great takeout financing as well. So that market is served well. That's why the pies are huge. Low-rise side served exceptionally well. Even duplexes served relatively well on the acquisition side. And if you want to buy, I mean, maybe we're not seeing purchase plus improvement stuff, but if you want to buy a duplex, if you're an end user and you want to buy a duplex, it's not that hard to find money to do it. Might actually be easier than buying a primary residence right now because you have the income, which will boost your application. You want to say something?
I was just going to say, just for anyone that wants more information on the MLI Select program, it's pretty amazing. They've actually gamified the system. There's 3 major: accessibility, energy, and affordability. We did a full episode on it where we go through it in detail, so I highly recommend anyone that wants to learn more about that, go check out that episode.
So where we see the opportunity, or what's missing in the market, is that there's really no credit products for triplex and fourplex. On the acquisition side, like if you're an end user and you want to buy a fourplex, there's not enough of them available right now, but if you did go to buy one, the bank's going to say, well, you're a first-time home buyer or you're a second-time home buyer, and you're going to live in, even if you're going to live in one of the units, if it's owner-occupied, it's not going to be as easy as it would be for you to buy a duplex. And so our goal is to start serving some of these markets. So you are seeing some residential lenders touching the fourplex stuff. You're seeing CMHC playing in the 5plex space, and we put 4+1 here, and Paul's a guy who's actually doing some exceptional work in that space, and it's still kind of a gray area, I think, right? Like, we have a zoning environment where you can save a ton of money on development charges right now. If you develop a fourplex, you have a huge competitive advantage against anybody else in the market because you're saving $30,000 per unit on if you're developing a fourplex, but you can't get good debt to build that fourplex because MLI Select starts at 5 units. There are apparently some workarounds, but we're still waiting for precedents need to be set, right? Yeah, so similar things. If you want to buy a multiplex, there's really not a lot of money in that space right now. B side, you start getting into the expensive stuff, right? I think. And some of the other interesting concepts that we're seeing, like co-purchasing, would be an interesting example where, you could just become tenants in common. Like Nick and I, could go buy a place and live in 2 units. These are real capitalistic responses to the housing crisis that we're seeing right now that just aren't well represented in the capital markets. And the big ones that we're going to focus on here is the adding of a single unit within an existing building and the addition of a detached ADU outside of an existing building on a residential lot in, eventually, I think, the entire province of Ontario because of Bill 23, but we can use the context of Toronto as well. So our question for you is sort of, what if these credit products existed? So we've been approached from our work on the podcast and couple of other things. We've been approached by a lot of groups in the family office space, in the investment space, in the tech space, and been gradually putting together this product that'll be sort of delivered through a tech channel, but also through the broker channel and things like that, where it's credit products designed to help people add a unit. We're even working with contractors as sales channels where they can actually sell the credit product not sell the credit product per se, but use the credit product similar to the way a car dealer would. Contractor can say, look, I'm gonna build a basement apartment for you, and it can be fully financed. So the deals are I'll go through kind of the mechanics of it, but the deals are underwritten on the way in, so we'll make sure that the takeout, like the refinance, makes sense. So it'll add enough value to the property that the person can refi back out, and the rents will cover the difference in debt cost. But our thought process here was, and this is kind of scaled up for Toronto, but we think probably in Ontario you could get away with lower numbers than this on a per unit basis. But what if you had, every time a unit turns over, if you had $50,000 credit product, so that you could go put makeup on a pig and and clean up the mess from tenant before and increase your rents because you've made the unit much nicer. The lenders like this because they see the increase in rents and they know that it's going to help to service the loan. Same thing, what if and this is the biggest one from my perspective, I actually think it's more meaningful than building a detached ADU. What if you could have $250,000 to put a basement apartment or an upper apartment in your McMansion in the GTA? Right? Because there's a lot of baby boomers with McMansions in the GTA.
No, on that note, so 250 again, that's probably Toronto prices from basically all the people doing these suites. Henry and Paul, you guys would probably know better than we would, but it's obviously a lot more expensive here than to do elsewhere in Ontario, across the country. Some staggering facts on empty space in current houses. There are currently 5 million empty bedrooms alone just in Ontario, and there's an estimated 30% of bedrooms across the country are empty. So we have the space, we're just not utilizing it. And instead of waiting for all these new houses to be built, which is going to take forever, even though we're pushing legislation that way, why can't we start converting some of the space that we already have that's already sitting empty into usable space through this credit product?
So mechanically, the way that this happens is we pre-underwrite the deal, so there's an underwriting fee. What's the loan to value? First cohort will probably be targeting less than 50% loan to value. We know that average loan to value in Canada is like 30%. So people who have houses who have a lot of equity in it, lower risk borrowers, we want to, the lender who wants to build this product obviously wants to start with them.
And those are actually probably primarily the people that have those spaces, right? A lot of people do own those homes free and clear. That 30% is really brought down by a lot of the first-time home buyers that are going in with 5% down, right?
Yeah. So you have your baby boomers with like paid off empty houses, basically. Step 2 is get your permits. So we would go to a company like Rojas and ask for them to pay, like to get building to go through the entitlements process. That the lender would advance a draw to that organization. So the lenders like the product because it's really easy for them to pay. They don't have to give all the money out right away. They can give it away in chunks. There's a draw schedule, and this is like super common in the construction space. So like that's just how your high rises would be built. They give it $100K at a time or 100 million at a time.
Yeah.
Like, big in chunks of money, not in one thing. And then step 3, and obviously this is an oversimplification, is build the unit, and that gets broken down into a subsequent draw schedule. I'm glad our construction guy left because this is probably all wrong. But it's just, it's just for purposes, like for illustrative purposes, kind of goes through. Let's say a 12-month. This is for a DAD, we're estimating a 12-month process. For an internal AD, we're estimating a 6-month process. And it goes all the way through from approvals to your occupancy, and then you can attach your draws, again, completely arbitrary numbers, illustrative purposes here. This is how the lender has to advance the funds, so they're not giving $100,000 in one shot, they're giving it out over the course of a 6-month period. You, as the owner of a property, let's say, or your client, if you have a client who owns a piece of detached property, they start with, let's say they're $1 million, they're an average homeowner in the city of Toronto or in the Greater Toronto area. They have a $1 million house, they only have $500K mortgage on it, so 50% loan to value. It has a single unit and it makes, let's say, you could probably rent that for $4,000 in most areas in the GTA. Their payment's $3,000 on, if you were to get that at a current, and like I think I put 5%, I think I used 5. So they have $1,000 positive cash flow. Again, oversimplification, but just for simplicity's sake, like this would probably be negative cash flow after your actual expenses. If you put 2 units into that, and it costs you, let's say, I put 200 grand, so it's going to cost you 200 grand to put 1 unit into that house, which is probably double what it should really cost, or I don't know, it's a little high. Well, let's say it's 200 grand. So you duplex that house. Now the house, let's say it's gone up. I think that's probably a little bit high, but let's say it's gone up to 1.4 million in value. You add in that 200K in debt into your into the mortgage, and it'll eventually be taken out. Loan to value doesn't change, right? So you're still at 50% loan to value. It's just a bigger mortgage. But what happens is your income goes up substantially, not by 100%, because now they're less nice units, but usually by like 50 to 75%. So in your mortgage payment now, because you're carrying a $700,000 mortgage, goes up to $4 grand, just over $4 grand a month. So you have more cash flow. So this expenses aren't going to change a ton. This should bring a single family detached asset that would be cash flow negative into cash flow positive, which is going to be important, I think, in recessionary Canada over the next 12 years. Yeah. Similar thing for detached ADU, and then I honestly didn't even finish these slides because I was just Nick and I had a hell of a week. So what I want to do is this is really a market validation exercise. So we have a lender who's part of this tech company that we're working with that wants to deliver this product, and they want to do it especially because they want to get through working with CMHC in that affordable housing stream. The goal here is to help create affordable housing and to do it within the policy environment that exists right now, and to use mom and pop investors, end users, individual landlords to have a meaningful impact on housing affordability in Canada. So we want to know, is there demand for this? Are people going to use this product? Am I missing anything? Can we just kind of have a general discussion on sort of on what your thoughts are?
I guess my first question, everybody, would be, who owns investment properties in the room? If you do, raise your hand. Who wants to? Okay, good. There we go. So yeah, guys, that's pretty much it. Any questions on this specifically? Obviously, we really kind of want to hear what you guys think about this product that we're trying to bring to market, and then of course we can answer anything else about Missy Metal, podcast, whatever.
Can you get into the qualifications? Are you qualifying on CMHC standards, all of their policies, or?
No, we would qualify based on, we wouldn't take a client that wouldn't pre-qualify for a takeout with an A lender, or with their existing lender, let's call it, but ideally with an A lender, at least at the beginning. So, you've got somebody with a 50% loan to value, they're going back up to a 50% loan to value, the income is going to be added back in from the new rental property. Either it's owner occupied or it's tenant occupied and they want to split it up, whatever it is. But we pre-qualify the takeout based on what a bank would say. So are they going to qualify based on those debt service coverage ratios, on that loan to value, on the income of the property? And we won't, because that's our de-risk, right? That's how the lender gets taken out. Ideally, the credit product is short enough that the lender doesn't even have to register unless there's a non-payment, because all the money's just going to the contractors and the value's being built in, and there would be a quit claim deed, I think, probably, which would make the most sense if there is a non-payment, then it can be registered. But the idea would be that it would be refinanced out very quickly.
So you wouldn't need a solicitor to get involved for the.
I mean, the lawyers are going to be involved realistically, but you don't need to register it on title, or you shouldn't have to.
But then each draw, when you're going to be forwarding over, you don't need to forward directly to the solicitor, or?
It'll likely go through a trust account.
Okay.
Yeah, but it won't have to be, it wouldn't have to be approved, and this is sort of why you want to become, or mechanically we'll have to become a mortgage administration company to execute this, but to do things like that, draw facilitation, but it's a good question, I think, and we're kind of in the validation of it, I think,
phase.
But I think, I don't see these being registered because they're going to be, the idea would be they'll be taken out by
fairly quickly.
Yeah, I think so.
Yeah, I mean, the ideal is a 6 to 12 month period, and obviously the ideal person gets back to that original loan to value with just forced appreciation and increased cash flow on that property.
Mm-hmm.
No, I think it's a good idea. A lot of investors are coming through and they want to get into, let's say, putting a unit at least.
Yeah.
So good idea again, but could you forward over the MLI podcast that you
Yeah,
have.
of course, yeah.
So question on like, again, on the exit, right? So I'm thinking of like the average person, this is also from like an anecdotal story I heard. So you're a homeowner and you're like gonna add like a garden suite now, because those are across the whole city.
Mhm.
And so you'll put in the money, you'll take the loan, and I think the concern would be, and what I heard in this story is like the added value, like how much added value is it? And,
Yeah.
and does their lender like actually recognize that? Because I've heard that they don't. So it's like, even though it'd be great to add this unit and get the rental income, they're concerned with the takeout and
Yeah.
maybe even the sale eventually, right? If like if the lender is going to look, for a new buyer, they're just going to take like the average price on the street. They're not going to attribute all that extra
Yeah.
value.
Yeah.
So,
Yeah, so-
that could be a concern.
Yeah, no, I've gone through that discovery process with 5 different appraisers.
Okay.
And the consensus seems to be that they will appraise at cost, which is not where we want them to appraise. We want
But
them
still,
to
it's
appraise
good,
higher than
something,
cost, but yeah, they will. Yeah, and so, if you can get, that's why we have to start with that 50% loan to value cohort until we get to the point where the market's setting precedents that houses with laneway suites are worth more, or houses with basement apartments are worth more. Then
Yeah.
then you have that spread that you can get a little bit of extra value out.
Right. Stay away from the 80s for now.
Yeah, you're gonna have to.
Yeah.
But so if it's at 50, then if and again I'm using $1 million, if it's at 50%, we add a unit for $200,000. They can still go up to 70% loan to value.
Right. Yeah. But that's safety.
Yeah,
buffer.
yeah, and we would underwrite them so like worst case scenario, this thing doesn't even appraise. It hasn't added any value.
Yeah.
And it's just like we figure that the product will be in demand enough. Like I think we'll probably have almost infinite demand. It's basically saying to people, you can get a free unit added to your investment property or your house.
Mm-hmm.
And so we can probably discriminate in that 50% at the beginning, and then go to phase 2 once we've established best practices, how to de-risk, and go to your 60% and below loan to value. And then as those precedents kind of get set, you would hopefully be able to have like I don't know. I think a lot of high leverage people maybe shouldn't be doing stuff like that. A lot of them should be selling, but
Yeah, totally.
And yeah, just to add on to that, so appraisers and lenders are looking at DADUs, so detached accessory dwelling units, which are laneway homes, versus ADUs or just basement suites for that matter, very differently. Everyone's obviously a lot more familiar with basement suites, the BRRRR method, for instance, buy, renovate, rent, refinance, repeat. The BRRRR method essentially tells you to put a basement suite in, and that's been around for quite a while. The DADU stuff, the laneway homes, that's where we do see a bit of a disconnect between lenders, appraisers, and homeowners and contractors and investors that have gone and done this and are expecting there to be, hundreds of thousands of dollars of equity built into it. And it's usually coming back at almost a break-even point when, in my opinion, it should be much more. But I do think we're still very early days for all this stuff. So, give it a few years, and I think, the world will catch up.
Yeah, I think one thing, so at Mark's Mill Shop, we really don't deal with missing middle. Obviously, we're on the commercial side.
Yeah, you guys are too big.
Yeah, exactly. So, I mean, I'm passing, so just to give you a little bit of background, so like I do apartments a lot, but I'm on the sales side, I'm on the research side, so I end up just coordinating the brokers on this. And one of the things that happens is we'll bring somebody to the table, and anything less than 20 units, they're just like, there's a risk factor for them, there's a scalability factor for them. If it's not sitting on land and they can't do a land play, they really don't want to touch it. But one of the challenges that I'm seeing, just maybe less so on the professional side, more so when just talking to people like you guys, is that so like we also are moving into seniors housing as a company. So in the senior housing space in Canada is quite challenging, but that's baby boomers are roughly age, I think 57 to 74 now in Canada, according to Stats Canada. So the big challenge is obviously they own a lot of the homes, especially in the suburbs, but they're notoriously A, not as rich as they should be to retire, and B, also risk aversive. They hold on to their money, they hold on to the cash that they have.
They don't want mortgages.
Exactly, they don't want mortgages. They want to take the risk of bringing in a tenant who's going to be likelihood is in their head. The tenant is likely going to be a younger person under the age of 40.
Yeah.
Reality is they're probably going to be an immigrant. So there's a lot of risk factors for baby boomers. So what's the incentive? Like how powerful do you think it's going to be within suburban markets where you have
Yes.
these homes?
Yeah, it's so interesting. The original thought around this idea came from and the reason that we were approached from a lender perspective. I mean, we've been thinking about this for a long time, just independently, but was this multi-generational tax credit thing that came out from the federal government. So I would agree with you, but the reality is we don't need 100% of baby boomers, and I don't even know if they're going to be the biggest market. But you could use 10% of them, or 2%, or 5%. Like there's a lot of them, and in a lot of cases they're probably not getting a tenant. They're probably getting their kids to move in because we have a housing crisis in Canada, and they have too big of houses, right? And so you can take one of these suburban McMansions in your Thornhill or whatever, and I mean that's a great duplex candidate. Honestly, like an old 3,000 square foot, 2-story, 4-bedroom house would make an exceptionally good duplex. And so that's where we kind of see it becoming meaningful, and like multi-generational houses are being encouraged. I mean, we're at the phase of the housing cycle in Canada where like nobody can afford to live the way that we used to, and the faster that, or as we start to accept that, real changes happen, like multi-generational. Like Europe's been doing it for a long time. Well, everywhere else in the world has multi-generational housing. It's like very unique to North America thing that people don't live with their family.
Everyone wants their own house.
And especially with boomers wanting to age in place, they want to have end of life care from their family. They want to be close to their family during the end of life period. They want to help their grandchildren be raised in that village environment. Like I think we're just realizing, whether it's through capitalism forcing us to realize it, or just for other reasons, maybe a secular shift in perspective as a result of the global pandemic, whatever it is, that we kind of want to be closer to each other. And I think, if for a baby boomer, if it means that their kid has to move to Halifax, or they have to cut up their house into 2 units and have them live there, I think a lot of them are going to choose that, right? If they're gonna, like, it's either that or never see my grandchild, or see my grandchild 4 times a year when I fly to Halifax, right?
So even to build on that, so we've done a lot of cold calling and door knocking to kind of legacy neighborhoods in Toronto, your Trinity Bellwoods, Corso Italia, Little Portugal, etc. And we're trying to solicit these places for our clients of ours that want to move into these places. And I've talked to a lot of old European people. They're basically telling me their house is their coffin at this point. They're not going anywhere. Call me back in 20 years when I'm dead, and you can buy it off my son, kind of thing. So this isn't just for investors. This is for, well, why would your son either move to Halifax where they can afford to buy something, or North Bay where they can afford to buy something and split the family up, when you could just go to one of those places in Trinity Bellwoods, build a beautiful duplex, mom and dad get the main floor, and because seniors need, right, the baby boomers don't have anywhere to go, and if they leave and actually realize that equity that they've built up over the last 20, 30, 40 years, they're not going to be able to go anywhere. They're going to be in Halifax as well. So it's kind of more of a consolidation of bringing people back together. This isn't just a play for investors, it's a play for multi-generational families as well.
Mm-hmm.
Final question. Okay, on the comfort level that you brought up, I'm picturing like someone with 50% kind of loan to value equity.
Yeah.
They don't know what they're doing, but they're like, okay, I'd love to add, forget the detached ADU, but like a basement suite or whatever. And they have a relationship with like TD Bank, right?
Mm-hmm.
Like what would be, let's go back to like the HELOC thing, like basically comparing, like maybe some points on that. Like, is there advantages to using your product if they just have like a regular HELOC?
Probably not. I think it would be tough to compete with for us to compete with a HELOC product. I think like the idea would be that it would be full scope. Especially like the lenders that we are working with want to fully manage the process.
Mm-hmm.
And so the idea is that like you're selling them a free ADU, or like free ADU it'll debt service itself, it'll build itself, right? Like there'll be a contractor. Like the idea is, a huge contractor in Hamilton that we work with approached us about this as well, and he was like, if you can give me that finance product, like I can sell thousands of ADUs.
I see. So it takes
It's
them out of the process?
More of a
Yeah.
service,
Yeah.
it's
So
a
it's-
full-scale
I
service
see,
from
I
start to
see.
finish,
Yeah. So
rather than...
Well, that makes more sense.
Because and so I think that the idea is, we're like among the competitive advantages is anybody can go, if they have 0% to 50% to 70% loan to value, and go get a HELOC behind their existing mortgage, and go hire a contractor themselves, GC it themselves, do all of those things themselves. And I think when you get into the DIY space, DIY financing, it's like financing yourself, GC it yourself, you start to fuck stuff up, and
Yeah, absolutely.
there's a risk. And so the idea is the consolidation of things and scale and economies of scale and best practices, and having a professional environment doing it protects them. Like, it's like, this is gonna be done perfect. This is exactly, it'll all fit into this exact amount of money. There won't be budget overruns, and if they are, those are absorbed by, like, everything's baked into that, let's say 100K. Okay, you're gonna get an ADU, it's 100K. Your credit fee's in there, your contractor fee's in there, blah, blah, blah. If it goes over, somebody in that supply chain suffers, not you, likely, right?
Mhm.
Whereas if you try and do it yourself, I think your margin for error
Yeah,
is,
that makes sense. They might have more. They might have more comfort with the lender
For sure.
in the HELOC,
Yeah.
but not the whole process.
Yeah.
So if you can sell it all together, that's a way to scale.
Yeah.
Well, and like, you don't. The funny part is, like, anybody in this space, like mortgage brokers, right, electrician, I think, right. You can't compete with the DIYer. The only time you ever get the DIYer is when they've screwed it up, and then you're going back to fix their problem. And it's the mortgage side as well. It really is. Honestly, people are like, I'm gonna go broker my own deal. I'm gonna go shop around to 5 different lenders. I'm gonna go to every single bank, and then I'm gonna come back to you 3 days before closing, right? Really, this is what happens, and ask you to fix the problem that I created. Same thing. Probably same thing happens with electricians, right? Oh, I'm gonna go wire this thing myself, and then like, this plug won't work. Can you come over? And then you're like, well, yeah, sure, but it's gonna be twice as much as I quoted you before, because I gotta redo everything that you just did. So, like, I think the DIY thing is, it's always gonna be there, right? I think, like, there is a shift, like a cultural shift away from that, because, like, our generation is just way less useful, and we've kind of gotten into, like, specialization and division of labor a
That's
little bit.
perfect for that
Yeah,
reason,
I think so. Yeah, gradually, I do think we'll get more and more into that. So, but competing with the DIY, I would just say, like, let them be.
Sure.
Yeah.
And if you look at some of like the target markets for this, right, especially multi-generational stuff, you don't have like nonas and babushkas trying to like, DIY finances and bring
Yeah,
in
sure.
contractors and that kind of stuff, right? There's the package deal really is the service offering from start to finish.
Cool.
Awesome. Thank you so much, Daniel and Nick.
Yeah.
Thank you.